Welcome to the Get Rare Show. I'm your host, Rasti, a property wealth strategist and founder of an independent buyers agency, Get Rare Properties. The purpose of this show is to educate, inform, and inspire you to take the right decisions about your financial well-being. Today, I'm joined by Shane Oliver, Chief Economist and Head of Investment Strategy of AMP Capital. You might know him from various finance journals and newspapers. Shane is a regular media commentator on economic and investment market issues and engages regularly with investors at public events and forums. Shane has extensive experience analyzing economic and investment cycles and what current positioning means for the return potential for different asset classes, such as shares, bonds, property, and infrastructure. I have the privilege of working alongside with Shane during my 3 years in multi-asset team at AMP Capital. It was an honor to work with you then, Shane, and an equally extreme pleasure to have you here today at Get Rare Show. Welcome.
Thank you, Rasti.
Great. Shane, this is an exciting time with COVID going on, lots of things around. It will be great to hear from your side, like the state of the economy. What's your indicators with regards to the savings rates, employment, whatnot? So what do you think where the economy is heading towards?
Well, that's a fairly big question. But by the way, thanks for having me on the program. It's a pleasure to be here. And I did enjoy working with you for those years at AMP Capital. But anyway, in terms of property markets and the broader economy, obviously that has a big impact. Coronavirus, unfortunately, is still causing havoc, even though many of us are in the process of getting vaccinated, probably going to be with us, unfortunately, for a little while yet. I don't think it's creating quite the same degree of fear as it was in March of last year when it was the great unknown. I think there is more confidence that humanity will get on top of it, and that remains my view as well. What we did see last year was a recession. The Aussie economy had the lockdown. When you have to go into a lockdown, you have to stay at home. You can't spend, you can't work as you used to, and that saw a big hit to the economy through the June quarter, particularly last year, but it saw us go into recession. The good news was that government in Australia and governments around the world, central banks provided a lot of assistance, lower interest rates, which most people would be aware of, but also more direct assistance, the so-called JobKeeper program in Australia and similar programs in other countries, effectively protected businesses, protected incomes, protected jobs. And that enabled us to rebound. And we've had numerous lockdowns. If I think about the Victorian one in late May, early June, that was the 8th lockdown since last November, starting with South Australia and rolling through various states. I live here in Avalon. I think you're on the Northern Beaches too. We had a bit of a lockdown around Christmas. We're sort of getting used to these things, but the evidence is that they bounce back. We bounce back quickly, providing they're relatively shorter. If they're not short, there's plenty of government assistance. And that's also the story around the world. If you look at Europe, it had a double dip recession. Wasn't too nice through December and the March quarter of this year, but in the June quarter, it rebounded. And that, of course, is they, like us, had that big recession at the start of last year. So the point about all this is that lockdowns do work in getting coronavirus under control, that we tend to bounce back fairly quickly once they're over. And I think the same thing will happen in relation to the Sydney lockdown and the various other lockdowns that we've been seeing across Australia recently. Victoria and South Australia have had a few and they've come out of them. And of course, Queensland is having some problems as we speak. So the very short term is, I think the economy has been quite resilient. It's well supported by government assistance. We don't have JobKeeper. We have something very similar. The Reserve Bank is keeping interest rates very low. We've also got bank debt payment holidays. Again, if you have trouble with your mortgage, you can go see your bank. So we're not going to see a flood of property on the market from people defaulting on their loans because they lost their job through the latest, say, Sydney lockdown. I don't think that's going to happen any more than it happened last year. And it doesn't feel nice. I'm now in the 6th week of sitting in this room as opposed to being able to go to work. Can't do the things I want to do through the course of winter. That's kind of annoying, but I don't think we should get too distraught. It's not the best, but I think we will pull out of this and we will see a recovery later in the year. Unemployment's going to head down to 4%. I think it means a bit of disruption to economic growth now, but pretty good growth through next year. In fact, quite strong growth. I think interest rates are going to stay around these very low levels. Yeah, those deals below 2% for the fixed rates, they've started to go away a little bit, but you've still got ultra low interest rates out there. That's probably going to continue at least into 2023. So an environment of ongoing low interest rates. So basically, that in a nutshell is how I see the macroeconomic environment.
Thank you so much, Shane. We always enjoyed spells, even on your Friday morning updates to the whole team. Such concise and yet so much details out there. So thank you so much for sharing this with the audience. So you touched upon quite a few things, but for the interest of the audience who are keen on the property side of things as well, we talked about the interest rates and the health of economy. How would you talk about the Australian market being resilient from the property side of things as well, despite of this thing happening here? So yes, interest rates are low, COVID is having an impact, but yet because of the stimulus packages and everything out there in Australian government context, like what we are doing, like as lots of people have actually rated Australia as one of the best countries to handle COVID. What's your take, personal one?
I think Australia is still one of the best countries to have handled COVID. I know there's a lot of argument in Australia with everyone pointing the finger, but the fact is that if we had handled it like the US and Europe, we would have lost an extra 50,000 Australians. That's a lot of people that you want to save. And I think that's a great thing to do. Our economy has also been stronger. We made a couple of mistakes, though. Our quarantine system hasn't been as well managed, and we were slow in getting the vaccines. We relied perhaps too much on AstraZeneca. We should have gone for some other ones as well. But anyway, be that as it is, I think it just puts us back a few months behind some of the other countries which are now reopening. What does that mean for the property market? Obviously, we're in a lockdown in Sydney at present. So far, auction clearance rates have held up pretty well. In contrast to last year, the auction clearance rate through the month of July was north of 70%. That's still pretty high in a longer term context. To put it in context, the auction clearance rate in April of last year, at the height of the first national lockdown in Sydney, fell to 35%. So we've come down, but not that much. A couple of things are going on there that people who might have sold and think, oh, well, I'm going to delay that. So there's a lack of listings out there. And so to the degree that buyers have potentially slowed down a bit, there's been perhaps an even bigger slowdown in listings. So that's a bit of an issue and keeps the market relatively tight. We also saw through the month of July, according to CoreLogic, so I was referring to the domain auction clearance rates there, and if you refer to the CoreLogic house price data, it showed a 2% rise in the month of July, and that's for dwellings, and of course it still remains stronger for houses than it is for units. So there's a bunch of things going on there, but the bottom line is that compares to 0.4% growth in April of last year, the middle of the last lockdown nationally, and of course in Sydney, the big one anyway of last year. So we have held up a lot better. I think people are perhaps of the view that they've got a bit more confidence than they had at the start of the national lockdown last year. There's the vaccines. There's better treatments for coronavirus. There's obviously very low interest rates, and they helped last year. There's government support packages. You can get the same amount of income you could have got last year if you've lost a full-time job as you could have got on a JobKeeper, and add a little bit more because JobKeeper was subject to taxation, whereas the current income support is not subject to taxation, which is a bit of a technicality. But anyway, the support for businesses from the state government. So all of those things, I think, and the experience of last year, I think has kept buyer interest and kept the market still relatively strong. It's not going to have the free fall or the falls that it had through the initial part of the lockdown last year. So my feeling is that there's still more upside to come. Interest rates stay low for a long time. We've probably seen the initial impetus from the decline in interest rates to below 2% for some fixed rates. That's behind us. So things will slow down. The rate of increase will slow down. But I think that property price gains will continue. This year, we're looking for property price growth in Sydney of around 22%, of which it's already done about 15, 16%. It's already up very strongly. Next year, it's probably going to slow down a bit. I think next year will be a little bit cooler in the property market, maybe 5% or so growth. And this is just the way the cycle is. You know, we go down. We had a big fall in 2019. We had a bit of a bounce then it got interrupted by the pandemic. Then we took off again. So I reckon we're going to keep going up, but we'll go up at a slower rate. The reason I think we'll see more gains is the economic recovery will continue, unemployment will go down, interest rates will remain low, and government incentives are still there to some degree, the first home loan deposit schemes, for example. Flip side, though, is that affordability is deteriorating. A lot of the impetus from low interest rates is behind us, and those things suggest to me that the rate of increase will probably slow down a bit as we go into next year. Now, if you look way out, 2023, maybe 2024, interest rates will start rising again and we might see another cyclical downturn. But that's a fair way off before we get to that point, before prices start coming down again. I know that affordability in Australia is quite poor, and that's a concern to me. I benefit from higher house prices, but I also think that Australian housing is somewhat expensive compared to other countries. But the reality is we do have these lower interest rates and the supply constraints in some parts of Sydney. Just think of Sydney's northern beaches, are quite intense. You can't, it's hard to get more land up here than there is. If you want cheaper property, you've got to go out to regional Australia and elsewhere to find it, where there's more space to expand into. But bottom line is, I think this cycle has further to go, and the next downswing is probably 2 years away, maybe 3 years away, before we get to that point.
Sure, and totally resonate all these views here because I do follow you and your methodology as well. But I also feel that if they are going consistently up, it will actually lead to a bubble as well. So to me, sometimes it's the healthy holdback of things. Like if we have a very good year, like this one we are talking about, 22%. If every year is doing this, then probably everyone is investing in markets as well, like property markets. So there's an element of risk that it can come down as well, and it's very healthy. You talked about interest rates as well, that yes, it's super low right now with 0.1 as a RBA cash rate, and then fixed interest rates of sub 2%, which is super low, especially when somebody can invest in a property and get a rent in Sydney market at about 3%, you are still making a neutral to slightly positive cash flow at that kind of interest rates. However, yes, interest rates should be going up because in my opinion, interest rates is a reflection of the state of the economy of the country as well, because as a national monetary policy, that one can, as a policy owners, they can pull the trigger one way or the other, but it's all relative, isn't it? Like what we saw earlier, 17% cash rate, nothing compared to what we have. If it's increasing, it's only healthy. Would you agree to that?
Yeah, look, you got to allow that interest rates are probably at the bottom. So see, it's like share markets. People say, well, the share market is very high. It's at a record level, in fact, and the PEs are quite high, but all assets are affected by interest rates. And so when interest rates on your bank deposit is just 0.5%, well, you don't mind paying a higher PE or getting a lower dividend yield to go into the share market. It's the same with the property market. So we've had a long-term tailwind for property markets and the share market for the last 30 years now, as interest rates have come down from double digit. The official cash rate in 1989 got to 18%, the mortgage rate got to 17%. Now those two numbers are 0.1% and 2 or 3% for the mortgage rate. So we've probably seen the big impetus from that massive 30-year fall that led to above average gains in property prices. It took a while for that to get underway, but by the late 1980s, but more importantly, I reckon it really started. It didn't start in the late 1980s. It started about 1995, about the time I bought this house that I'm sitting in now. And the reason I can say that is because I have a long-term house price index going back to 1926. If you look at it against inflation, we sort of churned around from the mid-70s into the mid-90s in real terms. Then we took off from about 1995, which is when I bought this house. Now, I'm not saying I had perfect foresight, but that was about the time that buyers in Australia realised that these lower interest rates are here to stay. When we initially came down from 17% cash rate and 18% cash rate and 17% mortgage rate in 1990, early 90s, we had a recession and people thought, oh, this is just temporary, rates will go back up again. And so the property market didn't believe it, but it started to believe it from 1995, 96, 97 onwards. That continued into the 2000s. And ever since then, we've had these cycles. Prices go up, interest rates rise, and they come down again. But the broad trend has been very strong price growth. And you have to allow, I think, that interest rates aren't going to go much lower than this, if at all. The more likely scenario is that in the years ahead, they trend up. So therefore, the rate of increase in prices will probably slow down in the years ahead. And therefore, you got to sort of think about what that changed environment means when you're getting into the property market. Make sure as an investor, you can get decent income flow to make up for price growth perhaps being a little bit less. But also just bear in mind that another longer term trend might be lower immigration levels than we've seen at the moment. Immigration zero. It's not there at all. But in time, with the vaccines, immigration will hopefully come back. I sure hope it does, but it may come back at a lower rate. And therefore, the pressure on the property market from very high immigration levels that we had between 2005 and up until the pandemic may not be as great as it has been. So we may come into a property market which is, notwithstanding the cyclical ups and downs, which is somewhat calmer than perhaps it has been over the last 20, 25 years. But that said, there's still cyclical ups and downs. We've seen the strongest part of this cycle. We're slowing down a little bit right now, not much if you're in Sydney. 2% compares to about 3.5% growth back in March. So I can say we've slowed down a bit in terms of monthly growth, but we're still very strong. But next year we'll see more of a slowdown and then prices going down maybe 23, 24. But just bear in mind, I think the background to the property market is changing a little bit. The years are changing. We're coming from that environment where interest rates fell dramatically, immigration was very high, to hopefully an environment where that property market's a bit calmer than it has been over the next, say, decade.
Sure. No, I totally, once again, I agree with that. However, I have a different take on the immigration here. So yes, the immigration is almost zero, or actually zero, because of the international borders being closed down. But then the argument is that typically the immigration is for the early skilled laborers, like as the young skilled labor or the tourists or the students. Either of these three categories doesn't really buy properties. On the other hand, lots of expats from Australia, like Australians settled elsewhere, they're trying to come back home because we have realized that this is one of the best countries and there's not much risking the lives of their loved ones in foreign country. They should come back. And what we are seeing is that the number of investors coming back or people who are buying the properties upfront, even sight unseen, is just going through the roof. So it's kind of catching up. I mean, maybe it's a trend which will not really last for long, but as of now, but until then that happens, then the immigration might open back later on anyway. So this is what we are seeing in the property market.
It will certainly reopen. What I'm talking about there is the underlying demand for housing. So immigrants tend to come in and they rent, and then that fills demand ultimately for housing. So it's people living in dwellings as opposed to whether they own them or not. And that has a big impact. There's also this impact at present that when people do come back, expats come back, and also people who just live in Sydney, they're saying, well, I don't want to live near Sydney. I don't want to be in the CBD, but I don't mind being north of Manly or somewhere, or in Manly or in the Northern Beaches, because it's actually come into its own through the pandemic as the focus has shifted from I want to be as close to work as possible to I want to live in a house or a location which has a good lifestyle to it. So buyer demand to some degree, I think, has changed a lot. We had a 20-year trend out of the suburbs, maybe 30-year trend out of the suburbs, getting closer to the city, no one wanting to be stuck in the traffic jams twice a day, to now one where people say, well, I can work at home. Technology has proven that. The pandemic has made me reassess my life values. I want a good lifestyle. And that's well and truly supported the Northern Beaches after many years of being, in some areas anyway, where I live, a relative underperformer, despite the fact that it's such a nice place.
Sure. And also because you talked about the affordability for the whole city or even metros in general, if you look at the national map of Australia, like the satellite towns like Central Coast or Wollongong, or even Blue Mountains for that matter, for Sydney, like people, to your point, like realizing that, yes, we can zoom in for the meeting, infrastructure is there, the IT infrastructure is there for them to work. They don't really have to be stuck in the traffic. So there has been a big demand surge for the regional cities, especially close to the metro cities where the workplace was before. And
yeah, that's a fundamental shift as a result of the pandemic. And I don't think we'll ever go back to the way we were before. We already had people working at home. Like I used to work at home one day a week. But now lots of other people have discovered that that works. And technology is such that it facilitates it. When I was working at home, most of the time I'd phone in, whereas these days we use Teams or Zoom or whatever it is. So I think things have fundamentally changed. I can't see us going back to the old ways of everyone wanting to be close to the CBD, close to your office, in there 5 days a week. And that means a focus on lifestyle, a focus on regional Australia, in a relative sense, regional Australia, regional New South Wales was underperforming for many, many years, except from a few select areas. But generally speaking, it was a relative underperformer. Now that part of the property market, houses out in the suburbs, in nice areas, regional property is a place which is in favour. And that's likely to continue for some time to come, perhaps years.
Sure, that sounds good. Going back to your chart that you talked about, starts from 1926, I actually do follow it. It's a very powerful chart to show the relative performance of all different asset classes. And the typical question that I tend to get is like, why invest in properties and why not in shares? And typically, coming from your team, my answer is that it should be diversified, balanced. So what's your take on the chart, just on those two?
Well, it's one of my favourite charts. I have another one which is a favourite because it goes back to 1900, but I don't have property data back to 1900. I've only got back to 1926. So the concept behind it is my favourite one, and it highlights the magic, as Dr. Don Stammer, who is a well-known Australian economist, used to point out to me, and I've sort of taken that on and think that's something you've got to go with. He also used to say, beware the cycle. So we all look at it and say, well, I've got to understand the magic of compound interest, and therefore I've got to invest in growth assets like shares and property. And then next time there's a cyclical downturn, lots of people want to get out. That's always strikes me as crazy. And then they miss out on the magic of compound interest. But basically what the chart shows is that assets like property, like shares, which are leveraged to the economy, benefit from economic growth, provide higher returns over longer periods of time than conservative or defensive assets like cash and bonds do. So therefore, if you want to grow your wealth, you have to have exposure to the growth assets. If alternatively, you have no risk tolerance, you don't want to hear any bad news about your investments, you're close to retirement, in retirement, you don't have a big balance, so you can't afford much up and down in the value of your investment, then sure, have your money in bank deposits getting 0.5% or whatever it is, but that because you know that the value of that capital is secure. But for those of us who want to grow our wealth and have good balances and want to continue to grow that balance, that wealth we have, then you have to focus on the growth assets. The difference between shares and property is that shares are more volatile because they're traded on the share market daily. They move up and down all over the place. And so you get that volatility there because of that regular trading, whereas the property market is not traded on the share market. It's traded in the property market, and it's a lot slower process. That has its downsides because if you want to get out, it can take you longer. We in wealth management industry call that illiquidity. So the share market is highly volatile, so it has that short-term risk up and down, whereas the property market is less volatile, but it's illiquid. You can't get in and out as easily as you can out of the share market. So the key to me, I think, is to have a mix of both. If you want to grow your wealth over time, you want to have a well-diversified exposure to different types of growth assets. The property market will give you exposure to the real economy. It's illiquid. You can't get in and out as easily, but it's relatively stable in terms of that sort of growth you get compared to the share market. Whereas the share market will also give you good growth. In fact, over the last since 1926, they've had similar returns. And the share market will give you greater volatility, but good growth. So I think you've got to have a mix of the two. Obviously, exposure in the share market gives you exposure to industry, to business, whereas exposure to the property market gives you exposure to the property market. And both are reasonable to have exposure to. So the key to me, I think, is diversification, have a mix of both. And that, I think, is the key insight from that chart, which I think it's a fantastic chart. It's the one that I use mostly. I regularly update it, at least once a year, thankfully. The message doesn't change much, but it is something a lot of investors miss out on because they're looking at the TV or listening to the media and the prices of property have done this or the price of property have gone down, and they think, oh, gee, it goes up as much as it goes down. That's terrible. Same with the share market. Whereas anyone who has seen that chart will realise, well, the trend is up. I've just got to focus on that over the long term.
Exactly right. It's the power of compounding, isn't it? Like the earlier the person invests into for long term,
that's right.
Of course, take into account all the fundamentals in place and the risk tolerances around it, not just go and buy anything for that matter. And yes, there's illiquidity there, but just like any other thing, as in property investors get rewarded for the risk they're taking or the illiquidity premium that they have to pay on that one. So that makes all sense. At the same time, also see that there's a different level of leverage available in the property investing. So if I have to go and invest in a particular banking share, for example, the only leverage I can get is with the margin lending loan, the exposure or the multiple of the exposure I can get is up to 2 times maybe. But here in property market, I can, with my 20% deposits, 5 times, 20, even 10 times, even 20 times. So that's, if we get the right leverage in our favor, it actually can go a long way, because the chart doesn't really talk about the impact of the borrowing there.
That's right.
So now the question is, everything being equal, everything being under the balance and the control, how come the banks are taking the property investing in a bit different way? When we see the chart together, the banks are putting a different risk premium to the share investing, just because maybe the margin loan, you can get a margin call effectively. But in the property investing, that's not really happening. Is that one of the reasons you would think?
It could be. Share market tends to be less leveraged in that sense. There's margin loans, they tend to be relatively short term. I think the banks have sort of felt that, well, property is safer over long periods, or even over the short term, really, even though they've got similar returns over the long term. But over the short term, property then is less volatile. So that's why they're prepared to lend more against it. Mind you, a lot of people get around all of this because you take a mortgage out on your property and then use that to invest in the share market. You get a lower rate of interest. You don't have to put up with margin calls. So you can sort of distort it and then still end up with exposure to the share market, which is leveraged, but it's benefiting from the mortgage on your property.
Yeah, that's a very good point. We can mix it up where the cost of borrowing and then invest in a very balanced profile for the individual. The other question that I have was more around the efficiency of the market. I know you did your doctorate thesis on efficient market or lack of it. What's your view in general? Do you think that the research that you did ages ago versus with your experience now, has your take on the market or the efficiency has been any different, or you have a bit more biased view towards, or what's your take on the efficient market side of things?
I think when I was looking at it, this was the 1980s, when I started looking at it, the academic view was that markets must be efficient. Otherwise, buyers, if you think about it, efficiency is basically you impound all the available information into the value of the investment. And therefore, all information that exists is already reflected in, say, share prices. And speculators can't distort it too far, because that would mean they'd have to buy high and sell low. And if they do that, they lose money. So for a speculator to make money, they would have to buy low and sell high, which over time would bring the prices back into line with what the efficient market hypothesis would suggest. But the reality is that there's lots of investors who come into the market in the short term, come and go, think they can get rich here and end up losing money, and that can distort the market for several years before it ultimately falls back to earth, falls back to being in line with what underlying fundamentals would suggest. And there's a lot of evidence, even academically now, to suggest, as my research showed back in the 1980s, that at least share markets aren't particularly efficient. They may be efficient in the very short term, but over long periods of time, they do get into periods where for 3 or 4 years they can be way higher than they should be, and 3 or 4 years they can be way lower than they should be. You can also show that to some degree in property, but the cycle's less noticeable. I think we got to a point in the mid-1990s where property values in Australia were way, way below what could be fundamentally justified. But at the time, investors and buyers were thinking, well, mortgage rates are going to go back to where they were in 1989. And that kept them very cautious till they finally bought into the view, well, interest rates are going to be lower for longer, and then property market caught up. Now, in recent times, you could argue, well, the property market has run ahead of itself the other way. There's been lots of calls since perhaps about 2003, 2004, to suggest the property market's in a bit of a bubble, contrary to market efficiency, and therefore it should come down. By the same token, I must admit, I've read these calls over and over. At times I've even thought maybe it's become a bit of a bubble and it's going to come crashing down. And of course, each time you think that's about to happen, it doesn't happen. So trying to make money out of that is hard, particularly in an environment like we have in Australia, where most Australians do everything they can to service their loans, where the central bank generally has been cutting interest rates. So if anything goes wrong, interest rates come down. And where there's been a strong underlying demand for housing over time. So I think the evidence is quite clear. Markets do diverge from fundamentals. They're not consistent with the so-called efficient market hypothesis. And you could argue that maybe that occurs over long periods of time in property. It's perhaps more evident in the share market, but over long periods of time in property, you can see a bit of that. But trying to make money out of that is often a bit hard. You're really looking for something that comes along every 20 years in the case of the property market, and which says, like, I was lucky in 1995 to get into the housing market when it was relatively cheap and about to start pricing in lower interest rates. And that, of course, is what's happened.
That's true when we are picking the right asset class for investing based on the fundamental efficient frontier. I guess that's where your actual work is around when we are talking about multi-assets. But I'm also talking about, like, within the share market, if I have to pick a stock today, then what sort of efficiency I can find, and or the lack of efficiency in the market is there, versus, as an example, finding properties in the property market. Because again, because of the illiquidity and the transaction cost, it just, and the stamp duty and whatnot, actually just changes the market or changes the whole lens that we're looking at, and then it becomes more inefficient as well.
It does. I mean, the property market is distorted substantially with stamp duty, which has the effect of putting a hurdle on getting into the property market and also putting a hurdle on getting out. Because if you want to sell your property, suppose you grow up on the Northern Beaches and you want to retire and you've got this really big property, but then when you sell that property, you want to downsize, you sell that property, you'll have stamp duty on the next property. So it dissuades people from selling. Whereas if you didn't have stamp duty, then you'd see more transactions, which would make it easier for retiring Australians to free up their property for young families who need them. So that is a distortion in the property market and adds to, I guess, what you would call market inefficiencies.
I'll also call it as a hand of God coming in there. This is great. No, this is great. And like you also mentioned about, that everyone is more like have a bit more understanding of the property market just because it's a real asset out there. People need a roof on their head to live in. And then at the same time, they look at the media, what the market's saying, what the commentators are talking about in the market, and that's what they actually start to feel. Yes, we can talk whole day about the fundamentals, but then there's something like consumer confidence, which actually goes a long way.
Those things multiplied, and that's what ultimately gives you these divergences from market efficiency. Like in the property market, we refer to it as FOMO, when people fear they're going to miss out. That can inflate property prices relative to where they should be. And of course, when property prices start going down, you can have a feel of FOMO, fear of not getting out, which can push prices lower as more people sell because they think if they don't sell now, it'll get even lower. Now, of course, in property, it's nowhere near as severe as it is in the case of the share market, where you have those things. You have runs and people think, oh, I've got to get in now, I've got to buy this tech stock or whatever it is. And you can argue that certain parts of the market are extremely speculative. Bitcoin, for example, seems to solely exist on the basis of confidence and what people think about it as opposed to underlying fundamentals. But that's a whole new topic to get into that one.
Yeah, at all. Like Bitcoin changes by what Elon Musk is talking about. Whether
I know, that's another topic. It tells me that it's highly speculative.
So true, so true. And what's your take on, because the banks have a major holding of the residential loan book and Big Four being guaranteed by the government. So the argument that I've heard in favor of property market in Australia is that if property market goes down, they're bringing the Big Fours down, and then they will probably impact the government as well. And so that is the reason why probably government will do whatever it takes to defend it. Like, what's your view probably on that one?
Look, I didn't have a strong view on that one. The other one, of course, is that about 2/3 of voters live in properties that are owned, either with a mortgage or owned outright, and they have an interest. 2/3 of voters have an interest in prices going up. I mean, that may well be the case, but we have seen periods of substantial declines in prices. The 17% decline in Sydney, which occurred from the high point in 2017, the low point in 2019, 10% across Australia through that same cycle. But it didn't bring the banks down, and most banks also do regular stress tests to make sure that they could survive at least a 20% decline in prices. So I don't really think there's a grand conspiracy keeping prices up here. It's really a function of low interest rates and underlying supply and demand for property, which has led to the situation we have in Australia. It's just that I think some of those forces which will push prices up may start to abate a bit in the years ahead, but we could be debating that one till the cows come home. But I think ultimately there is a limit. I mean, even if you did buy the argument that property market's just propped up by the banks or the government on the behalf of the banks, you'd have to say there is a limit to the extent to which that can occur, because interest rates can't keep going down forever. You know, one day they will hit bottom anyway. I tend to think the bigger issue has just been supply and demand, and that's probably, to me, that's the overwhelming factor in all of this.
Totally right. It's all about supply and demand. How many people are wanting to live in northern beaches versus how many people want to live in the regional towns out there. It comes down to supply and demand. So fundamentals of the investing, as well as together with the consumer confidence, like what they really feel. For example, what was happening in the last year when it was hit of the COVID, but then lots of commentators was talking about the fundamentals, but then the confidence sunk down. But after all the stimulus and everything, the confidence came back, and look at the market, what it has done.
Yeah.
So many things out there. But the key takeaways from me from this conversation today, Shane, is it has to be personalized for the circumstances. Like, not really, as you're saying, depending, like it should be a diversified portfolio. You also talked about that the risk capacity or the risk appetite for someone who is about to retire or in retirements, that 0.5% from the bank is far more better than risking that money elsewhere. So there's a lot of key takeaways for me. So thank you so much for your time. Really, really appreciate it.
Thanks
what
for
would be the last
program?
Sorry,
Thanks for having me on the program.
But my pleasure. So just before that, so just what would be the last comment for you to the audience, if at all, that you'll be saying about their investment journey or what they should be considering?
Look, I think focus on the long term. Invest in things that you won't necessarily have to hold for 10 years, but at least you should have a longer term time frame in mind. If you did have to have it for 10 years, 20 years, you'd be happy with that. Always make sure you get a property in a good position. It's not going to be built out or depreciated in some way by things going on around it. Make sure, if you're an investor, that there's good underlying demand in terms of tenant demand for that property, so you get a good income flow. But to me, the key is always make the most of compound interest. You're investing in property or anything else. It's a growth asset to get good growth over the long term and grow your wealth. Don't get thrown off by short-term swings in the economic or investment cycles. Invest for the long term, make the most of that compounding.
Thank you so much once again, Shane, for your time. Really, really appreciate it. Plus, you all enjoyed the session today. Please do subscribe to our YouTube channel so that we can keep you posted with the market updates and discussion with the market leaders. Once again, thank you so much, Shane, for giving your time and sharing your views on the market. Everyone, thanks for listening and tuning in. Keep safe and happy investing. Thank you.